Welcome to video 8-1, where we begin chapter 8 about lean accounting. And I created a GIF there with pictures of Gene Sibelius, the composer, because often his work is considered to be relatively lean in the musical setting. Symphonies are a little more to the point than the grand, expansive symphonies of, say, Mahler, or the operatic works of Wagner, which were often are largely contemporaries of him. So chapter 8 goes into lean accounting. Now, this is not a chapter that's going to give you every detail about lean theory, but I'm going to go over the important details that are necessary for us to understand how the accounting system will change if you have a lean mindset. And I'm going to try to make the lecture video itself lean and shorten it and try to get just the valuable pieces of information to you and get as much bang for my buck for my different examples and things that I discuss. So I think this does a lot of the work right here. So let's think about this for a second. We have our profit. This is largely what a lean person thinks about when they think about the profit equation. They have the profit and they say, look, revenue is driven by a certain number of things. Likewise, cost is driven by a certain number of things, and there is some overlap between these factors. And mathematically, I think that makes sense. I hope makes sense. Let's translate that into what really it means. Let's just say, for example, there are. Let's say this is as an analogy like building a plane. You know, a plane needs some lift and some propulsion, and alternatively, there are things that it doesn't need that drag it down. And so, if you're trying to get an airplane to fly or fly better, you will have difficulty, say, getting rid of the engine. Yeah, that's hard. That would be, let's say, X1. You need an engine. Now, you can try to manage the engine over time to make it more economical and try to trim what you can, but really just ditching the engine, cutting weight and drag by ditching the engine here, well, that's also going to get rid of all your propulsion that you need. This is an analogy of a business being like an airplane here. Likewise, you need wings. Wings provide lift by way of Bernoulli's theorem here. Let's just say that wings are x2. They're the function of lift in this example. You could lose a lot of weight by ditching the wings. Oh, sure. But you would have difficulty in many cases. Having a normal plane get any lift if you just got rid of the wings. You'd have to create a rocket or turn it into a helicopter. And even then, helicopter rotors are effectively wings, or they simulate the same kind of idea happening on a mini scale. And so I'm not going to go through the analogy much further. The idea is that there are some things that you couldn't trim if you're trying to drive down weight and drag on an airplane, because they would get rid of your propulsion and lift. But there are other things over here that are only bringing the plane down. And so, you're going to round off the edges. Let's say square edges on an airplane, that's creating extra air resistance, or it's catching the air, which is creating extra drag. Let's just call it X6. So square corners on an airplane. Well, no, let's ditch that. We can get rid of that from the cost side of this analogy, and not lose anything over here. X6 does not drive revenue at all, or does not help the plane fly in the analogy. All right, I think the analogy has gone far enough. The idea is that the lean mentality says there are some things you can't really cut, and there are some things you definitely should cut. This is waste. Now, a lot of lean people, a lot of lean practitioners think about primarily the waste. That's their focus, because the lean accounting system, the lean mentality, is designed to get you in a mindset and designed to make the information systems of the company and the decision-making system of the company aim with laser precision on eliminating waste and saying, look, we've got all these things right here that add to the cost function, that drive the cost function up, that are not required for revenue. That is to say, they're not part of the value stream that we'll talk about in just a little bit. And so, there are other things, though, so it's important also to say that's not the only thing that lean says. Lean does not say everything is waste and we're always cutting. In fact, that's the critique that lean has. The primary critique lean has of traditional cost accounting is that it creates this myopic focus on anything that decreases the cost function is good, and it leads companies to effectively ditching the engine to the airplane. So there are some costs that you can't avoid. Identify those, and you'll need to manage those over time through some sort of system of continuous improvement. But you can't get rid of those. They are driving the value you're providing to customers. Assuming you have an actual meaningful value proposition, you can't just ditch the engine to your airplane. That is the lean mentality. It's a 1-2 punch. Don't just think about the waste part. It also means that there are some things that are not waste. Identify those as well, and you're going to manage those in a different way. Cutting costs over time, sure. Making them more efficient for how much bang you're getting for your buck. Airplane engines, let's get one more last little leg out of this analogy. Airplane engines have increased tremendously over the years from when the Wright brothers brought their little putt motor out there on a Kitty Hawk in North Carolina. This is the engines now would be unrecognizable to them, at least at first. So we have improved the engines over time, but you can't just get rid of them in most cases. All right, so that's the analogy. I think I've done plenty with that analogy. Okay, so the first thing we're going to talk about is you know what? Let's go through this list. This is going to organize the chapter, and this is how the chapter just goes. There are 3 big topics we'll talk about, and we talk about value stream income statements, and we have some costing, some changes to the costing that you do for inventory to try to reduce the inventory and to reflect the fact that lean mentality reduces inventory. And then also we have some costing techniques related to time and time-related waste. So value stream income statements help us identify waste and non-waste. We have inventory costs, which are very much waste, and so we're going to change some of the costing we do for inventory to reflect that, or a lot of inventory costs are waste in a lean company. And then we also have the idea of, let's identify some waste in terms of time, and the accounting system can be leaned upon to provide, I didn't even mean for that pun to happen, but the accounting system can be used to identify time-related waste and some time-related metrics. So value stream income statements. The idea is, first of all, we have a value stream. We have that's the engine of our let's get off that analogy. Wow, I just can't drop it. Just let it go. The value stream is the sequence of activities required to bring the customer from order to delivery. It's what we do that the customer cares about, because they order from us and they want to get what they ordered. If anything between order and delivery that directly impacts the customer is part of the value stream. And anything that, and almost more importantly, or just as important, is the idea that anything that does not directly affect the customer and help bring the customer from order to delivery is not part of a value stream. And so you need that is a prime target for waste reduction. And it's not to say anything that's not in the value stream is waste. It's just that it deserves much higher scrutiny. It is more likely that it's going to be waste. Whereas items in the value stream are less likely to be waste. Are there waste items in the value stream? Oh, sure, you bet. But it's less likely, it's more likely that those are critical drivers of your revenue as well, that they're providing value to the customer. And so you need to manage them over time and try to improve them along through some sort of system of continuous improvement. I use that term because there are all sorts of different systems that lean companies use to over time improve their systems of value, the value stream itself. Okay, and so what we can do is we can now create an income statement that reflects this. And I have a pattern here. We saw it in chapter 6 and a little bit in chapter 7. This sounds like a very simple idea. Oh, well, we're just going to take the income statement and make it reflect the value streams. Well, that also has some ramifications. There are some follow-on things that happen. So we're going to have a set of changes that we make to how we present the income statement. And this is primarily a management accounting tool. It really is not intended for showing to financial entities. So financiers of some kind, to stockholders, to banks or whatever. It's not its primary purpose. It's made primarily to help the company improve itself. It's in a lean mindset. All right, so I had some trouble when I was coming up with this chapter. Lean is not covered very heavily in most of the textbooks that I could find, and when you look for it online or in lean practitioner handbooks, every consultant and lean person has a different opinion about things. So I've tried to pick out what are the common threads among different lean practitioners. But you know what? If you Googled lean, you might find some people who have a slightly different opinion on 1 or 2 items here. But I think most of what I have is the core of what a value stream income statement is, also called a plain English income statement, plain language income statement. and how how it differs from a traditional income statement. Okay, so there are three things that seem to be the hallmarks of a value stream income statement. Three changes that we have that, well, okay, we're going to make it reflect value stream. What does that mean? It means these three things. First of all, we don't use variance adjustments. So typically, your income statement in a traditional sense will have something along the lines of this. Oh, we just finished chapter 7, so we're all on board for all this stuff, aren't we? Look at this. We have all our DM and DL and overhead variances, because we peeled these variances off into separate accounts before we debited to WIP, which eventually went to finished goods, which eventually went to cost of goods sold. So this cost of goods sold number is expressed at standard under a traditional income statement, and then we have all the adjustments down here. Now, you have been through an accounting class, and no offense, but a good number of you are still not sure what variances are and how they work, and what to do with this section of the income statement right here. And you have studied accounting. So this setup is in practice very difficult for non-accountants to understand. They just don't. It's hard to get it through a large audience's head what exactly this traditional income statement means. And so it's not, this is one of the critiques anyway. That's the argument. I'll give that caveat. This is the argument of the lean practitioner that this is not understandable enough to the general audience. And so we're gonna get rid of variance adjustments. We're gonna report actual costs. Remember that we had a diagram that I had linked to in chapter 7 towards the end of the chapter, right before 7.8. So in 7.7, we're putting everything together. We're talking about what a cost accounting system is. It answers these 5 questions. There's a diagram about it. Well, in that diagram, it talks about the input measurement basis, and one of them is pure historical, which means just look at the actual history of what the costs were. And guess what? Lean systems like that better. The value stream income statements, typically, they say, you know what? Why not record WIP at actual? Why not record finished goods at actual, and therefore cost of goods sold at actual? Get rid of all these adjustments, which nobody understands outside of the accounting department, and even part of the accounting department doesn't understand them. And then give people the actual numbers of what happened. Now, the other corollary to that is the lean practitioners say they have to argue that we're really, as in the accounting department and in the management area, we're not getting much bang for our buck from these variances. They have to basically argue against everything we said in chapter 7, or at least give a compelling critique against chapter 7. And what they say is that, let's see if I have it in here. No, I don't think I have it in here. What they say is that the variance analysis tends to push managers over time to cut the engine to your remember I was going to drop that analogy. Gets you to cut these costs that are not good. They're not good to cut. They are good. They're good costs. It's not good to cut them. There you go. Because they drive your revenue as well. So for example, when you're a purchasing manager, I gave a silly example at one point of the idea that the purchasing manager went into the alley and picked up some bootleg metal or something. I forget the example exactly. It was bootleg upholstery. That was what it was. Yeah, it's silly, but if the purchasing manager's bonuses and incentives and future promotions and performance evaluations are at least partly based on that price variance for direct materials, that purchasing manager has all the motivation in the world to do something very similar, if a little less cartoonish, to get cheap materials. And as long as that purchasing manager has no accountability to what happens to the direct materials quantity variance, they'll just get the cheapest materials possible. Now, does that drive value? Actually, I bet cheap materials is something that also drives value to customers, and they don't like having cheap stuff that just falls apart just a few months after the purchase. This little GIF right here. Yeah, classic scene from Star Wars. They don't want something that falls apart right after they buy it. Whereas, a manager motivated as I just described will try to get low quality direct materials, and on the other hand, the production manager will try to get lowest quality direct labor that he or she can. So their argument is, hey, you know what? A lot of these variances drive you to do things that are counterproductive to your value streams in the first place. Nobody understands them, and it's a lot of extra work and cost to incorporate them into the system. So That's why they say, let's just record the cost at actual. So when you have a value stream income statement, you're going to see everything here, at least above the lines up here at actual. We have an adjustment we're going to talk about in just a second right here, and some allocations that can occur. But typically we're talking about actual revenue for the different value streams, actual costs in the various categories. No adjustment. There's no standardization of them. They're not set at some sort of standard quantity or standard price, or were expressed at a standard quantity or standard price. No, just the actual amount spent. Now the second thing, I jumped down a little. Well, no, I kind of get at it here anyway. And so these are the value streams that actually earn some revenue. There are other quasi value streams, is how I've called them. I love that quasi word. You saw it all over the place in chapter 7. But these right here don't directly bring in revenue, but they help support the value streams in a longer term or more indirect manner. And so there's an argument that can be made that, we also should say that these are not going to be as full of waste as you might think. You might have some difficulty cutting these, not because they drive this period's revenue, but because they might drive future periods' revenue. And so these are going to be quasi-value stream columns, and you're gonna separate these out. And the idea is that they're business sustaining. They sustain businesses or the business or products over the long term. Now, there are other things that are here, they're just support costs that really don't have long-term implications as far as improving the value stream products. They don't directly impact the value stream, which directly impacts customers, like these two are argued to be in this example. And they really are, they have a relatively high likelihood of being waste. You could call them support costs, which is what I've titled it here, or other costs. You could be really on the nose and call them waste costs. Although that's not technically true, because it's not to say that all these costs are waste. It's to say that they have a high likelihood. Let's be real. Let's have some significant scrutiny that we give to these costs in this column right here. All right, so that's how I've set this up, and some companies don't care. Anything not in the value stream becomes suspect, and they'll just put all this as a red sort of either one column, or just consider all of these to be support or other costs and likely to include a lot of wastes. But some companies will make a distinction on this level and find that valuable to their decision making. We have value streams, very reluctant to cut costs there. We'll try to manage those with the process of continuous improvement. We have some longer term quasi value stream segments here, and so we'll manage those with a mixture of trying to cut waste and also trying to still get some value long term over through some sort of continuous improvement process. Oh, and then we have support or other costs, pure support or other costs. Yeah, let's go ahead and just attack those as much as we can. Now, let's read this real quick. That lean similarities to process costing. Since lean firms trace costs to the value stream and not to individual product units, notice that. That's a significant statement. We have violated the rule we've been following since chapter 4. The idea that you have to absorb costs into individual product units. In fact, you have to trace any costs individual product units. So, we're not tracing. Typically, the costs are traced to the value stream level and accumulated at the value stream level, and that's it. That's often the case with the lean firm. They don't trace it any further than that. They don't take it to individual product units. They are going to mimic process costing in the sense that they're going to take the costs and just divide them up by how many units they had. Now, you're starting. I hear the groans. I hear the concern because chapter 6 had a lot of complexity to it. Well, the lean firm is not going to be interested in complexity, and they're going to say, you know what? We're going to take that very early on idea that you had about costs just being averaged out, and we're going to just ignore all the complications that a process costing system can add. Remember, as we went through that process, I think that's one of the good things, pat myself on the back here. It's one of the reasons why I went after the idea of let's tie process costing in at the base level to this idea of averaging costs out to individual product units, because that's what it is at its core. And lean companies often will just latch onto that and stop there. If they trace the dollars in revenue or in cost to individual product units, they're just averaging them. They're just taking, we had X number of product units, and so we had $395 over X in materials costs per product unit in the parts value stream. And so, yeah, we have some similarities. But it will end up, I promise you, it ends up being relatively simple, a lot like the initial steps at the beginning of chapter 6. All right, the third characteristic of a value stream income statement is that because we're reporting on actual costs in the current period, we have a problem balancing the income statement and the balance sheet. Some of the costs of goods sold are from goods that were sold this period that were produced last period. So we have an inventory problem.
We've got to make sure that the income statement and the balance sheet play nice.
So because we're only looking at this period's costs right here, we have a problem. We're not incorporating the costs from last period for goods sold this period. And so we have some of this revenue that was earned in these value streams might not be for goods produced this period. We as a lean company, we often are not worried about matching those up. We're worried about what we're doing now. Did we get a lot of sales now? Did we earn a lot of or incur a lot of costs now? What is the current period? What you're going to do is you're going to try to because you have to make them play nice. You need to have this adjustment, and you're going to place it as far down as you can because you just don't want it to invade these important numbers right here. You want to see, well, this is what we made this period on this value stream. This is what we made on this value stream. And this is what these other quasi-value streams or support costs have cost us in addition to that. And so that by itself puts an emphasis on the cost of these. We're not assigning any revenue to them, makes them less profitable. This inventory adjustment could obscure some of that. We want this line of sight. This is bolded over here. It's separated out by space, and I have the top line and double bottom line right here. This is what a value stream income statement is intended to do, is draw your attention to right here. Now, when we have these adjustments out here, then we have an inventory adjustment. So we had an opening inventory value of $1,181,500. And at the end of the period, we closed our inventory of $651,000. So the idea is we have sold off a lot of inventory. And so our costs of goods sold includes that amount of sell-off. Some of the inventory from last period was sold this period, so some of that revenue actually belongs to inventory last period. So we have to incorporate this extra expense here that will reduce our profits. So this is a downward adjustment of our total value stream profit. Our total profit, which is talking at the value stream level here. All right, netting all the value streams. There we go, and quasi-value streams and support streams, support costs. And so, at this point we have a little under $1 million when you take this cell and combine it with this cell. And we also have a corporate allocation, and you still might have some, even in a lean firm. This is perhaps more on the questionable side. Some companies that are lean may not be interested in doing this because it becomes more complex. When you do this, we're talking about that in chapter 10, the idea of allocations within the company. We'll talk about it in a support versus production department context, but the idea of a corporate allocation is very similar. You have costs incurred in one part of the firm that are incurred on behalf of a different part of the firm, and so often companies will just move those costs over. They'll say, you know what, those costs, they're going to that part of the firm that incurred the costs for you, they're going to charge you for that. So we have corporate, which is going to charge this production factory or whatever this value stream income statement is pertaining to, charge them a certain amount. All right, that just so you're not concerned about what that means. And then when you take that about $1 million, once you have from this to the adjustment, you take away this corporate adjustment, and now you end up with the net profit over here. And this will tie to the traditional income statement. Let's see if I did that in the book. Did I make it tie? Oh, look, I did that. I did make it tie. It also brings. It also highlights. I'm spending a lot of time on this. I don't need to. But it does highlight the fact that we have the inventory adjustment down here. We also have separate this corporate allocation, and you might not see that on a traditional income statement. That corporate allocation is probably somewhere embedded in the SG&A costs over here. Part of it I could theoretically get to cost of goods sold, I guess, but not, most of it, if not all of it, is going to be here in SG&A. Be a very special circumstance to get into COGS. So this could throw some people off because they say to themselves, well, why is the company penalizing itself for bringing down inventory? I heard you earlier, Professor Knox. I heard you say that lean companies think inventory costs are waste, and they want to lower the value of their inventory. You did. You heard me right. Yeah. But it's not that they're reducing their it's not that they're punishing the firm for reducing inventory. They're just identifying the responsible party. Look, we have a lot of costs that are coming out and offsetting some of the revenue that we earn because we have value coming off of the balance sheet going into the income statement here. So some costs that we incurred earlier, we put them into a different asset inventory. They weren't recognized as expenses then, and they're going to be expensed now. It's just part of the process of sloughing off this excess inventory. And we can identify it very clearly. This amount right here is going to be embedded in the numbers up here. There's no way to feasibly pull it out of COGS and the variances in a normal circumstance. You just can't get it out very easily. And so the value stream income statement highlights it and says, look, we are losing some of our net profit is due to the fact that we just had to slough off some inventory. And it also holds people accountable if they try to overproduce to increase their profitability. We'll talk about this a little more when we talk about, I think it's the next section, a little more when we talk about, say, direct and throughput accounting and direct costing and throughput accounting. We will talk about that more. But the idea is under a traditional costing system, you actually can increase your profitability by overproducing because you're pushing a lot of fixed overhead costs specifically. That's the big winner there. You're pushing those onto the balance sheet instead of getting them expensed right now. If we had this in reverse, let's say we had opening inventory of $651,000 and closing inventory of $1.18 million. So we increased the value of our inventory. We started overproducing and increasing, which was, that's anathema. That's bad for a lean firm. But let's assume we did that. We're going to have profitability that's much higher than this number right here. But because we have this adjustment, we have identified very clearly why we have that. We've called it out. We've said, you know what? It's because we've put a lot of value, a lot of our costs this period went onto the balance sheet. We can't claim such a good net profit. We just delayed those costs till another period. All right. So next we have reduced inventory accounting, and you know what? I think this is a good place to stop. I'm going to go ahead and cover this next section in the next video. That's all that I have. Bye.